Welcome to the Tesla Economist. Please hit the thumbs up and don't forget to subscribe.
Why is Tesla's PE ratio so high? Currently, Tesla have a PE ratio sitting around 1400. So to interpret that, it would currently take 1,400 years for Tesla to make as much in earnings as their valuation. That's absurd, you might think, especially for an automotive company. So let's break it all down and see if we can make any sense of why the PE is about 70 times as high as Volkswagen's. For starters, no one was complaining about Tesla's PE ratio when they weren't making any profits. There is a threshold going from losses to profits, and at one stage you cross over the break-even point. When you're exactly on break-even, your PE is infinite, as you make $0, and if you divide the valuation of the company, e.g. $50 billion, into zero, you get infinity. And then if they made only $1 million after that, then the PE ratio would be 50,000. Now, 50,000 is an incredibly high PE, but it's moot, as the company is just crossing over from break-even. This is how the math of PE works. PE ratio is not the be-all and end-all of valuing a company. There are many metrics that investors use to determine a company's valuation. Another ratio is the price to revenue. In 2020, Tesla did around $31 billion in revenue. Their current market cap is around $800 billion. In other words, their valuation is approximately 30 times revenue. Now, this is a high figure, as in, if they made 100% profit on everything they did, it would still take 25 years to recover the investment. But Tesla is a growth company, so we expect these revenues and profits to increase with its growth. Therefore, these metrics are simply not a way to value a growth company. These are used more for the traditional value investing strategies, used by investors like Warren Buffett. They just analyze data and numbers all day and try and calculate whether the company is undervalued or not, mainly based on return on investment, which is why PE ratios are a valuable factor to consider with such investment strategies. However, in my opinion, I think value investing is antiquated. It meant that Buffett missed out on Tesla, sticking to his old ways. In his defense, it did also keep him out of the dot-com bubble as well. He openly admitted he didn't understand it and doesn't invest in what he doesn't understand. Buffett has a lot of experience, but experience can count against you at times too. The world is moving much faster these days. With the leverage we get from technology, you can't sit around reading charts all day waiting for the prices to adjust, because before you know it, the price has doubled again. I have nothing against Buffett at all. He is a really smart, knowledgeable guy, and I like his partner Charlie Munger even more. But times have changed. We're in a new era, the era of low interest rates. Now, when money is practically free, i.e. interest rates are historically low, then there's very little point putting your money in the bank earning 1% or so, and then tax on top of that, while inflation continues to increase around you. Then, on top of that, you hear about these other stocks around you skyrocketing. You're no longer looking for the stock that pays a 10% dividend yield. You just need to beat the 1% you get in the bank. And it doesn't even need to be in the form of income. Capital appreciation will suffice, particularly with liquid equity stocks. These days, stocks are simple and easy to trade anyway. In fact, easier than setting up a bank account in the first place. So, with barriers to entry and low expectations and returns, we're seeing a new paradigm of the stock market and new entrants into the market, particularly with the likes of Robinhood facilitating trade even further and allowing people to buy fractions of a share rather than the entire share if they can't afford a whole share. In addition to that, the information that is available about investing and companies online is available to everyone readily and easily now. It's no longer about insiders with their Bloomberg machines. Even memes go around that help people understand what investing is about. HODL has been a great word that spreads so much knowledge in just 4 letters. It helps people understand that investing is about holding, not trading. Just buy and hold, and forget about it. And Buffett has been saying this too. Gone are the days where you have a hot broker moving you in and out of stocks each time as they increase, and earning a commission on every trade. You buy a stock, it goes up, and you sell it for a quick profit. Pat yourself on the back, rinse and repeat. Now, investors, or regular people sorting their retirement even, are patient. We're prepared to hold on to stocks for 10 to 20 years, or even longer. We'll hold through the booms and the busts. And we know it's important to make sure you never put yourself in a position where you have to sell. Because the times when you most likely have to sell is the same times everyone else has to. And supply and demand will dictate that if there is less demand, the price will drop. Okay, let's get to it. Is Tesla's PE ratio too high? People talk as if Tesla's PE ratio is that high in a way that makes you infer that that's all the profit Tesla can make if they tried. But what if we looked at it as if they cash cowed the business now? Then wouldn't that be a more fair PE ratio? So how about we do some econometrics to work out what their PE could be, just to add a bit of credibility from my last econometrics model on estimating Q4 revenue. I came in at 10.9 billion and the actual income was 10.7, or a difference of 1.4%, which I think is pretty on the money. So let's see if we can do something similar again. In Q4, Tesla had a free cash flow of $1.9 billion. So this would imply that if they stopped all investments in the company now, that is how much profit they could make. Considering Tesla had ramped up more in December than the start of Q4, I think we could safely assume that now they would be at the equivalent of $2 billion free cash flow a quarter. And if we scaled that up annually, then we'd be at $8 billion free cash flow. Just a quick disclaimer, free cash flow can be somewhat manipulated, as for example, Tesla may not have paid one of their suppliers in Q4, and that bill is due the following quarter perhaps. But even if this is so, we don't need to be super accurate here to the point I'm trying to make. So a way to interpret this would be if Tesla stopped all investments now and just wanted to make profit, they'd be making approximately $8 billion a year, which would equate to a PE of 100, a lot less crazy than 1400, but still about 5 times more than Volkswagen's if you value it as an auto company, and 3 times higher than Google's if you value it as a tech company. So I would like to build on the base of this potential profit and calculate a future price to free cash flow ratio of Tesla's current factories when they're completed and ramped up, to give us a future PE ratio of when these operations are completed, and then if Tesla decided to stop all growth there, which they obviously won't, but I think it will create a more fair way of valuing the company using PE ratios. The new S and X have recently been launched. In 2020, Tesla delivered 57,000 Model S's and X's. However, their capacity is 100,000, and it would appear that these new models are very popular and seem to have a waiting list already. So it would appear the demand for the new designs should take them to full capacity. And with the new $10,000 extra price tag, this will add significantly to profit. So I feel comfortable adding an extra billion to profit from these activities, particularly when we factor in that the Model Y and the Made in China Model 3 were not being totally ramped up through Q4, taking our potential free cash flow from 8 billion to 9 billion. According to Ron Barron, he recently stated that the Shanghai factory makes $2.5 billion a year profit. And he says this is the factory doing 250,000 cars a year. In other words, he's not including the new Shanghai Model Y factory.
China, about $4,000 a car. And the factory in China is probably at 250,000 people. Thought it was going to be a 150,000 car factory, and that was the opportunity people perceived. And but we thought that they could do millions of cars a year in China. And that one factory they built so far is a 250,000 car factory a year, and which is now at the rate it's producing. And that's making somewhere around $2.5 billion a year. So they invested $1 billion. That's making $2.5 billion. When you invest in
the new Shanghai Model Y factory has a capacity of 200,000, and although Model Y likely has higher margins than the Model 3, let's just round it to $2 billion profit a year from that. Makes sense. Model 3 does 200,000 cars a year, makes $2.5 billion a year. Model Y does 200,000 cars a year and makes $2 billion a year. So let's add that $2 billion from the Model Y Shanghai onto our estimated future annual free cash flow of $9 billion to take us to $11 billion. And we have Berlin, which has an expected capacity of 300,000 Model 3s and Model Ys per year. However, production costs may be higher in Germany than China, particularly labour. So let's just say they can produce the same total profit as Shanghai, despite the higher output. This is highly conservative, as I also think the Berlin's Teslas will sell for a higher price than the Shanghai ones, and they have likely learned from Shanghai and made more efficiencies. In addition to that, Chinese FSD orders are much lower in China, which is a very profitable side of the business, and would likely be a lot more popular in Europe. But we don't need to be super accurate with numbers here just to make my point. If Shanghai is doing 5 billion, then I see no reason why Berlin shouldn't too. So let's add that onto our future free cash flow, taking it from 11 billion to 16 billion. And then of course we have the almighty Austin, Texas factory, which at a guess will be twice as big as Berlin. In other words, $10 billion profit a year, which brings our 16 billion to 26 billion. So this is just from what we have in production now. If Tesla waited to cash in the entire company once Shanghai, Berlin and Texas were fully ramped up, then it could have earnings of around $26 billion, giving it a future price to cash flow ratio of 30, which if Tesla so choose to, could make it their PE ratio. Now, this doesn't include level 5 autonomy, robotaxis, solar, 4680 batteries, or energy storage growth either. In other words, if they made no new investments, this would be their PE ratio around the end of next year when it is all come into fruition. This is on the basis of Ron Barham being correct with his numbers. Tesla don't provide us with these figures, but as Barham Funds is one of Tesla's largest holders and have likely done their own models and possibly more privy to a bit more information than your standard shareholder, then I see no reason to doubt them. So given this, it would appear Tesla is still probably undervalued, at least in my opinion. Anyway, it's definitely going to be an exciting couple of years, so don't get too hung up on the current PE. As you can see, it's just a distraction. Thanks for listening. Please hit the thumbs up and don't forget to subscribe.